Maximizing your business tax deductions for realtors. Copyright 2015 Real Estate Board of Greater Vancouver. Course description. Welcome to the Category C course, Maximizing Your Business Tax Deductions for Realtors. The specifics of tax-deductible expenses are elusive to many realtors, whether you are new or seasoned in your practice. This course will provide you with a clear understanding of what expenses are tax-deductible, how to ensure your records will hold up to Canada Revenue Agency CRA scrutiny, and provide you with options for tax savings. Presented by a former CRA auditor and a certified professional accountant, certified general accountant CPA CGA with over 25 years in tax preparation and consulting, this is a must seminar for all members. Learning outcomes. By the end of the session, participants will be able to 1. Explain the difference between an employee and a subcontractor and ensure that payments to them are deductible expenses. 2. Identify what expenses can be deducted from income earned and those that can provide maximum tax deductibility. 3. Recognize what a proper receipt for tax purposes looks like and what steps need to be taken to ensure the receipts that you are provided stand up to CRA scrutiny. 4. Describe the criteria for claiming auto expenses and how to handle situations where more than one car is used for business. Determine whether buying or leasing a car is best for you. 5. Identify if claiming home office expenses is an option and how to make a claim for home office expenses. 6. Explore what record-keeping option is best for you and your business. A typical day in the life of a realtor. 8 a.m. In my home office. Grab my morning coffee and breakfast. Check Twitter feeds for any relevant real estate news. Tweet something of interest to my followers. Check my emails and any voicemails. Generate my list of to-dos. Post a Facebook marketing campaign. 9 a.m. Drive to the office for weekly office meeting. Discuss relevant real estate information. Target goals for listings and sales. 10 a.m. Office tour of new listings. Tour can last up to 2 hours. 2 p.m. Time for lunch. Meet up with colleagues at local restaurant. It's a short 5-minute walk from the office. 1 p.m. Meeting completed. Walk back to the office. 2 p.m. Back at office. Respond to more emails and voicemails. 2:30 p.m. Set up appointments for prospective buyer to view homes in the evening. 3:30 p.m. Prepare comparative market analysis for prospective seller for following evening. 4:30 p.m. Shop online for client closing gift basket for recent selling transaction. 5:30 p.m. Back at home for dinner with family. 7 p.m. Meet buyer at the office and drive to view 3 properties. Purchase coffee to go at drive-through Starbucks for you and your client. 8:30 p.m. Back at office. Review and discuss properties viewed with buyer and determine which ones may be suitable, if any. Make appointment for other property showings later in the week. Using the scenario on the previous page, please identify what 4 things the realtor did in a typical day that you might think are allowable tax-deductible expenses. Facebook, gas, online shopping, Starbucks coffee for client? We'll find out. Independent contractor versus employee. What's the difference? It is important to determine whether a worker is an employee or a self-employed individual. Employment status directly affects a person's entitlement to employment insurance benefits and how a worker is treated under other legislation such as the Canada Pension Plan and the Income Tax Act. The facts of the working relationship as a whole determine the employment status. refer to Appendix A, Use of Statement of Business or Professional Activities Form, T2125 on page 31. Number 2, iClicker. Can a spouse or child be paid for services provided to a real estate agent? Yes, no, or maybe. Well, I have my guess, but we'll see. Independent contractors. Refer to Appendix B, Request for a Ruling as to the Status of a Worker, CPT 1, form on page 37. Any cost associated with having a subcontractor is tax deductible. The better question to ask is if the person working for you is in fact a subcontractor or are they an employee. There are several factors that need to be considered to be able to determine the status of a worker and include 1. Who determines their hours of work? 2. Where is the work done, their place of business or yours? 3. Who determines the rate of pay? 4. Whose tools are used? 5. Is there a risk of loss? If a person hired is actually a corporation, then there is no question that the corporation is a subcontractor. If you are uncertain, you can file a CPT-1 form to CRA, who will make inquiries of both the worker and the employer to confirm the status. Wages and benefits for employees. Wages paid to staff along with all benefit costs, such as the employer portion of CPP and EI, WCB, and any extended health benefits are all deductible as a business expense. Allowable tax-deductible expense categories. Bank charges. Personal versus separate business accounts. Bank charges are often missed when claiming business expenses because they have been paying them even before becoming a realtor. Now that you are a sole proprietor and assuming you use your personal bank account for all realtor operating costs, that personal bank account is also now your business bank account. As such, this means any bank charges may now be tax deductible, including the ATM fees and the monthly fees that you pay. However, if you instead decided to open up a separate business bank account, then only the business bank account fees are tax deductible. Is it better to have a business bank account, or can you use your personal bank account? The best answer here is that due to the nature of the real estate business, it is often difficult to determine how well your business is doing, and all too often one is surprised with an unexpected tax bill come tax time. As such, we do recommend a separate business bank account be kept, into which all sales commissions are deposited and from which all business expenses are paid. For funds needed to cover personal costs such as housing costs, personal debt, personal credit card charges, clothing, and food, a transfer should be made from the business account to the personal account, and careful track should be kept of those transfers. As a rule of thumb, setting 20 to 25% aside of the amount of your gross commission income plus 100% of the GST collected would be prudent, as this will cover most, if not all, of the taxes due for the year. For example, month of June 2015, commission income $10,500, GST $500, gross commission income $10,000, amount to set aside for taxes $2,500. $10,000 times 20% is equal to $2,000. GST $500. Business licenses, dues, memberships, and subscriptions. If your municipality requires you to have a business license, any fee paid for that license is a business expense. Dues that are paid to obtain or hold your realtor status are business expenses. However, this category includes much more. If you are a member of any sort of a group, like the Chamber of Commerce, a networking group, or the Board of Trade. Those membership fees may also be deductible. Service groups are also a great place to network, and thus fees paid to be a member may also be deductible. When it comes to subscriptions to magazines or the newspaper, the first question you have to ask yourself is if you are using these publications for general interest or for research. If the reason is research, then the magazines and newspapers should be related to the real estate industry or include information related to the industry. If the publications are of general interest nature, then they most likely do not have a business purpose, so the cost may not qualify as a business expense unless the publications are being used by clients in a waiting room. If that is the case, then any magazine or newspaper subscription costs may be considered a business expense. Business insurance. The costs of the premiums paid for liability or other types of business insurance are considered deductible for tax purposes. Delivery and freight expenses. Courier or other delivery costs are tallied under this category. 3. iClicker. Can you deduct the cost of a new computer in full from your real estate income in the year you buy it? Yes, no, or maybe. And I have an answer in my mind. We'll see if it's right. Equipment purchased. Equipment that costs more than $500 will need to be kept track of separately as it will be depreciated over time, as opposed to the cost being deducted all in 1 year. You will need to separate out like pieces of equipment, such as computer software versus computer hardware versus office equipment versus office furniture. This is because the different types of equipment will attract different rates of depreciation. Equipment rental or lease. Deciding if you will rent or lease a piece of equipment will usually be a factor of cash flow as opposed to tax deductibility. If you lease equipment, the cost of the lease is tax deductible, so long as the equipment is used solely for your business. But if you buy some equipment, the above rules will apply. 4. iClicker. Can you deduct the interest paid on your line of credit cards or loans? Yes, no, or maybe? Have an answer ready. Interest. Now, this is a category that has some very specific rules when it comes to the tax department. There is an income tax folio that specifically discusses interest deductibility, which is S3 F6C1 that was released March 2015. The key line on this folio is that in order for interest to be tax deductible, the purpose of the borrowing has to be for business purposes. Let's say you want to go out and buy $10,000 worth of computer equipment, but you have to borrow some funds to make the purchase. If the bank lends you the $10,000, it means the interest on the loan is tax deductible because the proceeds of the loan were used to buy business equipment. Pretty straightforward. Unfortunately, that's not the real world. The real world is, I've decided to become a real estate agent, and I am going to use my credit card and line of credit to fund the business expenses until the first sale closes. So the question is, how do you make the interest paid on the credit card and the line of credit tax deductible? The simplest way to maximize your chances of CRA accepting the interest paid as being tax deductible is if you use a separate credit card to pay for the business expenses from one that you use to pay for personal expenses. By using two separate credit cards, any interest paid on the business card can be linked to business use, while that paid on the card, usually for personal purposes, can be linked to personal use. If you have to carry a balance on one or both of the credit cards, be sure to pay off the credit card used for personal purchases first or make larger payments to the personal credit card rather than the business one. If you use a credit card for both personal and business purposes, The problem that you run into is you have to allocate all interest charges and payments made proportionately to the business portion versus the personal portion, which can be very cumbersome and may not present the most beneficial tax deduction. If you are certain you only want to or only have access to one credit card, then another option is available and might even result in lower interest charges. If you establish 2 lines of credit, one for business purposes and one for personal purposes, then you can keep track of your business versus personal credit card purchases as simply as with a different colored highlighter. If the payment to the credit card is made from the 2 lines of credit for the exact amount of the business versus personal credit card charges, then it is clear that the business line of credit was used for business purposes and thus the interest is more likely to be tax deductible. It is recommended to attach all the business receipts to the Visa statement where all business expenses are highlighted so that it is really easy to see what the business and personal expenses were and to ensure no receipts are lost. Note that a receipt includes not only the credit card slip but also the itemized receipt. Legal and accounting. Legal fees incurred to allow you to run your business, be they for contracts or any other business-related matters, are a business expense. Fees for bookkeeping. Tax consulting or preparation of your tax returns are also considered a business expense. With regards to incorporation costs, those will also be a business expense, but will be deducted over time. The rationale for this is that the company will last a long time and thus the cost of setting up the company should be deducted over time as well. The cost of keeping your company alive in Victoria, whether you file the report or your lawyer does, will also be a business expense. Maintenance and repairs. Costs for repairing your computer would be an example of this expense. Repairs made to property in order to facilitate a sale or inspection fees paid as part of your commission agreement may all be examples of this category of business expenses. Office expenses including postage. So we are back with PST in British Columbia, and because we have PST, the rules in place before the HST are back again, which means that school supplies are again PST exempt. If CRA was to audit this expense category, what may be looked at are supplies on which no PST has been paid. If this is the case, then a school supply exemption was applied for at the time of purchase and thus removes the expense as a possible business expense. So be honest with the cashier and pay the PST. You are much better off than saving that 7%. Office expenses also include small items such as pens, pencils, paper clips, stationery, and stamps. Office expenses do not include items such as calculators, filing cabinets, chairs, and desks that cost over $500, as these would be capital equipment purchases. Professional development. This course would qualify as professional development because it qualifies as part of your PDP credit requirement. As it is not a post-secondary course and is not an accredited course through a university or college, you do not get a tuition tax receipt for the fees paid. As such, any PD or business-related courses that you take here or at Small Business BC would qualify as a professional development business expense, so keep this receipt for your business write-off. Referral, commission, split fees. Fees paid to other realtors to split a commission are only deductible if the total amount of the commission is included in income. Usually the house splits the fees in order to ensure the rules of the Brokerage Standards Manual are met. 5. iClicker. Can you pay a referral fee to an unlicensed person? A. Yes. B. No. C. Or maybe. Take a guess. Excerpt from RECBC Professional Standards Manual. Trading services. 1. Practice standards. H. Paying and receiving referral fees. Some licensees pay or receive referral fees. Typically, referral fees are paid by a licensee for receiving a lead, which results in the licensee earning remuneration. A licensee might receive a referral fee for referring a client to another licensee or service provider if that client uses the services of that other person. The following are issues that licensees should be aware of related to the payment or receipt of referral fees. Paying a referral fee to an unlicensed person. A licensee may pay an unlicensed person a referral fee as long as 1. The unlicensed person does not solicit, for the purposes of making a referral, the names of persons who may want to acquire or dispose of real estate. 2. The practice of making referrals is not the main business of the unlicensed person making the referral. And 3. The unlicensed person making the referral does nothing else that would require them to be licensed. Refer to the definition of real estate services in Section 1 of RESA. Those who intend to pay a referral fee to an unlicensed person have an obligation to first ensure that person satisfies the above criteria. Section 6.1 of the Council Rules prohibits the payment of any remuneration to an unlicensed person in relation to real estate services if that person is required to be licensed. For this reason, it is important that a brokerage has clear policies and advises its licensees accordingly with respect to the payment of referral fees. It may also be useful to obtain independent accounting advice with respect to any tax implications that may be associated with the payment of referral fees to unlicensed persons. Supplies. This is where you put anything that you need to run your business. If you need rain gear to show a recreation property, recreational property, then that would be a business supply. If it is needed for your business, it is a physical item and does not easily fit into another category. The supplies category would be a good fit. Telecommunications, cell. If you only have a cell phone on which business and personal calls are made and received, a portion of the expenses. Cell. If you only have a cell phone on which business and personal calls are made and received, a portion of the expense will need to be reduced for the personal portion. In other words, you cannot claim 100% of your cell phone costs. There must be a personal portion allocated to the cost. Internet. Costs associated with your internet charges are a business expense, so long as the internet is used exclusively for your business. Home telephone. If you use your home telephone to make business long-distance calls or have special features on your line to facilitate your business operations, such as call forwarding, call waiting, etc., the cost of those business long-distance calls and special features could be claimed as a business expense. Travel. 6. iClicker. Can a trip with the family where you look and find a house that your clients might be interested in buying be tax deductible? Yes, no, maybe. 7. iClicker. Can 100% of a trip to Toronto to attend a real estate conference be tax deductible if you bring your spouse who is not in the business? Yes, no, or maybe. Business trips to attend a conference would be an example of allowable travel costs. In this case, the costs would include your flights, hotel, taxis, and conference fees. CRA does limit convention expenses to a maximum of 2 events per year. Research travel costs will be scrutinized by CRA for purpose and results. As such, costs to check out the market in an area you are not an agent in for comparative purposes or just to see what is out there are most likely not sufficient business reasons for CRA to allow the applicable expenses as a business expense. If your spouse or child attends with you, only the cost of your trip will be tax deductible. Costs associated with trips that have both a business and a personal purpose will need to be allocated between the two purposes. Automobile. The key with auto expenses is that you have to keep track of the expenses on a per-car basis. As such, if you have two cars that are both being used for the business, this means you want to keep track of each car's expenses separately. The expenses to keep track of will include gas, fuel, auto insurance. When it comes to insurance, you have to have business insurance to make the optimal car expense claim. If you only have personal use coverage, the insurance only allows you to use the car 6 days a month to drive to and from work. As there is no business use allowed, this type of insurance coverage will not allow you to claim any As there is no business use allowed, this type of insurance coverage will not allow you to claim any costs for the car. In other words, to and from work kilometers are not business kilometers. Similarly, if you have to and from work insurance coverage, you are allowed to use the car for business purposes 6 days in a month. As such, by doing the math of 6 days times 12 months equals 72 business days a year, divided by 365 gives you no more than 20% business use for that car. Accordingly, to make the maximum claim for a car, you have to have business use insurance coverage. Repairs and maintenance. This category includes smelly things hanging from the mirror, new mats, car washes, oil changes, new tires, wiper blades, body work, insurance claim deductibles, etc. Lease payments. The maximum claim for the 2014 year is $800 per month, but this does not mean you will necessarily be able to claim the entire $800. There is a lengthy calculation that needs to be made that will include the retail cost of the vehicle, the taxes paid, and the number of days the vehicle was leased in the year. Loan interest. The loan interest, not the payments made, will be part of the deductible expenses for the year. Capital cost allowance. The cost of your car is not an expense in the year of purchase, but rather that cost is deducted over time. This deduction is commonly known as depreciation, but for tax purposes, the term is known as capital cost allowance, or CCA. If you purchased a car in the year, the cost amount will need to be provided to your accountant. However, if you already owned your car when you started working as a realtor, you will need to know the value of the vehicle on the date you became a realtor in order to calculate the CCA for the vehicle. The amount claimed in a year for CCA is based on the cost of the car and is limited to the lower of the cost, or $30,000, plus PST and GST. If your business is registered for GST, then the claim is based on the lower of cost, or $30,000, plus PST only. For example, calculation for capital cost allowance, CCA. The cost of the car. Car A owned, $25,000. Car B leased, $100,000. Maximum cost for CCA purposes, $25,000 for car A owned, and car B is $30,000. The PST for car A is $1,750. So the total is $26,750. The CCA for year 1, 15%. For car A owned is $4,012.50. The undepreciated balance for year 1 is $22,737.50. The CCA for year 2, 30%, $6,821.25. The undepreciated balance for year 2 is $15,916.25. The CCA for year 3 is 30%, $4,774.88. Undepreciated balance year 3 is $11,141.38, and so on. The total kilometers driven for business purposes in the year and total kilometers driven in the year. To properly calculate the kilometers driven in the year, a simple way is to ensure that a reminder is put in your day timer every December 31st or your year-end date if you operate via a PREC. To calculate the kilometers driven for business, a logbook should be kept in which you indicate where you drove, how many kilometers were driven to get you there, the date of the trip, and the purpose of the trip. The log should be kept for 1 full year, which will establish your business use percentage via the calculation. Total business kilometers, total kilometers driven in the year. As such, if in 2015 your business use was 12,000 kilometers and your total kilometers driven was 24,000, then you have 50% business use. You are also required to keep your logbook for the next 3 months of the next year. If in those 3 months the total business use percentage has not fluctuated by more than 10% higher or lower, then you can just assume the same business use for that subsequent year. Using the example above, if in the first 3 months of 2016 your business use was 4,400 kilometers and the total kilometers was 5,000, your new ratio for 2016 would be 88%, which is more than 10% higher than 2015's 50%, and thus a full log will need to be kept for 2016. However, if in the first 3 months of 2016 your business use was 2,400 kilometers and the total kilometers was 5,000, your new ratio for 2016 would be 48%, which is within 10% of 2015's 50%, and thus no further log will need to be kept for 2016. So what happens if you do not keep a logbook? CRA can question the percentage claimed as business use and may apply industry averages or even totally disallow your claim. If the latter is the case, appeals may reverse or amend the auditor's adjustment, but the process is lengthy, tiring, and very stressful, and thus it is recommended that a logbook be kept. Automobile use calculation. Gas fuel for owned car A, $1,236. For car B, the leased one, is $3,875. Insurance, $1,648. For car A, car B is $2,478. Repairs and maintenance, $3,492 for car A, and car B is $674. Lease payments, nothing for car A, but for car B, it's $14,940. Reduction in lease to maximum allowable. For car B, it is $4,668. Loan interest, maximum $10 per day. For car A, it's $378. The capital cost allowance for car A is $4,012.50. The total cost per car A, $10,766.50. For car B, it's $17,299. The business kilometers for car A is 1,200. For car B, it's 28,000. The total kilometers for car A is 24,000, and for car B is 32,000. The business kilometer ratio for car A is 0.05. For car B, it's 0.88. The allowable deduction, A times D, for car A is $538.33. For car B, it's $15,136.63. The maximum of $800 per month plus PST for car A is $10,272.